What you want to watch out for right now with this particular stock market is you have to watch out for inflation. Inflation has been a huge subject of debate for a very long time since the start of the pandemic. And I really I'm starting to rethink my views on how we've handled inflation in this economy. So the big debate with the Federal Reserve and Chairman Jay Powell is this: when the economy starts to go flat, you kind of pump it up. You pump it up the same way you put air in a tire. You want to inflate the economy to kind of like you pump up that tire so you can get back on the road, right? But you know what happens if you pump up a tire too much? What happens to the tire? What happens to a tire when you put too much air in it? Somebody answer the question so we can know we're on the same page, right? What happens? So if I pump too much air, then eventually pop, right? Well, that's kind of the issue that happened with the Fed, in this pandemic. So here's what happened, and this was, I don't understand it completely. I don't agree with it. I think that it definitely expanded inequality in America and created a really weirdly dysfunctional economy. And let me explain. So COVID happens, right? Nobody knows what's going on. Nobody knows what this pandemic's going to look like. Everybody's freaking out. It's March 2020. So we're going to go back about 18 months from today, 18 months ago. And you can go back and watch, content and videos I made back at that time where I was telling you to buy everything you can get your hands on. I wasn't telling you to do it. I was telling you that's what I was doing. And you saw what happened. I mean, everything just recovered like that. I was thinking it might take a year for the market to recover. It took about 3 weeks. So people were making money very quickly at that time. That was a good thing if you were an investor. That's why I told you guys that the America's never going to change, but Black people should be investing so that America, as long as it's continuously holding on to its capitalist greed, at least you can benefit from that greed, right? You benefit by being an owner of assets. You do not benefit by being a worker, getting wages. They keep workers' wages as low as possible, and then inflation is still hitting. So think about this, right? You literally, you have a couple of years where you get a 2% raise, but inflation is 4, 5, 6%. Well, then that means your income is dropping, right? It's dropping because inflation is higher than the amount of money that you're getting. So it's a really screwed up, crazy situation. So Jay Powell, in order to save the economy, they pulled all the stops, all the emergency measures. They kind of, you could argue that they almost panicked a little bit, and they started flooding the economy with money. They started inflating the hell out of the economy by just, doing what they call a bond buyback program. That was one of the things that they did, as well as a lot of fiscal spending and stuff like that. And the thing about the people in Washington is that they just kind of take care of rich people first. So they started pushing out these PPP loans, and they got eaten up by the corporations at the top. It's almost like if you're feeding your dogs and you've got one really big dog and you got a bunch of little chihuahuas, and you throw food out there and you just say, okay, all of y'all can eat. Well, the big dog's going to eat all the food, right? You have to do something. You have to make you have to create a level playing field by pulling the big dog back and saying you get to eat after the chihuahuas eat. They didn't do that. The big dogs, the big corporations went out and they ate good. That's why Elon Musk, his net worth went up by about $200 billion during the pandemic. That's why Jeff Bezos' net worth went up probably about $100 billion during the pandemic. These guys were making like literally insane amounts of money, like $1 billion a week and stuff like that, or $100 million a day. I mean, it was kind of ridiculous and insane, while at the same time, a lot of people were losing everything. So a lot of this money that was going out into the economy, it kind of flooded the economy a little bit. They were just sort of recklessly pumping all this liquidity into the economy, which increased the deficit and the debts to tremendous levels. A lot of people were worried about pending inflation, and then inflation did come. They said, look, you're throwing money, you're flooding the market with money. Of course, money is going to become less valuable, right? You're going to have inflation, right? And that did occur. Now, the debate was, though, why is the inflation here? Some people said, well, the inflation's obvious because you're just pumping money into the economy kind of recklessly, and you're pushing the interest rates down, and that's going to basically cause us to everything to inflate. But then there are other people who said, no, the inflation is temporary. This is coming from supply chain issues, right? Because COVID stopped the ability of many companies to simply make their products or get them to market. The trucking industry was hit by COVID. A lot of these industries were hit in a way where they couldn't provide supply. And when you have restricted supply on any commodity, that's going to cause prices to go up because the commodity is harder to obtain, right? So ultimately, there was that ongoing debate. But what's kind of happening now, though, is that the Fed is starting to have to backpedal on its original position that the inflation was temporary. There are lots of economists who, since the beginning, have said, you're making a mistake. This is terrible. You're going to screw up the economy. And the recent inflation numbers uh, kind of verify some of that. Right now, the critics are winning. The Fed is not winning this debate, in my view. So the big thing that's happening now is you're having inflation hit the market. That's part of the reason that your stocks kind of took a nosedive earlier this week. You had a little bit of a bounce back today, a little bit of a reversal. That's very natural. That happens a lot. Now what did surprise me, though, to be honest with you, is I thought that Bitcoin and Ethereum was going to go up a little bit, because Bitcoin is seen to be what they call a hedge to inflation, meaning something that you invest in so that if inflation does happen, your Bitcoin will go up. For every dollar you're losing in stocks, you're gaining a couple dollars in Bitcoin, so everything kind of balances out. But no, yesterday was kind of interesting because Bitcoin dove too. Bitcoin's down to about, I think, 60,000 right now. I think that the downturn, from what I've gathered, is probably due to a lot of the speculators who jumped into Bitcoin and were hoping that the price would go up, up, up. And then when it started going up, they just started selling. And so you have a little bit more supply of Bitcoin to the market, which is going to push the price down. I still think long-term Bitcoin's going to hit 100,000. I thought it was going to hit 100,000 by January 1st. I now believe it's going to probably be maybe March or April or something. But I'm a big investor in Bitcoin. I really believe in Bitcoin. I really believe Bitcoin's gonna make a lot of moves. Now, one of the things that's really interesting is I like to, because I've studied stocks and all this stuff for such a long time, I come up with these weird philosophical ways to kind of view value in stocks. Now, somebody saying they can't hear. Give me a yes in the chat if you can hear me okay. Because somebody said, let's see, greater APRI says they can't hear me. Okay. All right, so give me a yes. Just put a yes in the chat if you're able to hear me, because I want to make sure I'm coming through. Okay, thank you, Guerda and Arnold. I appreciate it, and Mark and Keith. All right, okay, so I see a lot of yeses. Okay, you've never been clearer. Thank you. Okay, good. I'm glad I'm coming through clearly. All right, so here's the thing. I was thinking about what it means, how we feel. Me. I have a wife that's a therapist, right? So we talk about feelings a lot, which is a little bit weird, right? As a man, we don't do that as much. But I'm like, okay, this will expand my thinking. So we talk about feelings, and one of the things I was thinking about is that, and it's appropriate for money because money creates a feeling. Not having money, give me a yes or no. How many of you feel like crap when your money ain't right? How many of you feel stressed out, unhappy, miserable, upset, anxious if your money ain't right, right? Exactly. You have a lot of feelings associated with money. And that actually affects the psychology of money is very, very big. It actually affects how you even choose who to date and things like that. A lot of people, particularly women, I noticed this when I wrote my book, Financial Lovemaking, a lot of women can't deal with a man who's financially irresponsible. Like they just can't. Like that's worse than being a cheater and a liar and an abuser. If you're financially irresponsible, then there's no romance without finance, right? Then there are a lot of men though who also have emotional reactions to how they're feeling when it comes to money. When they don't have money, they're kind of sad and depressed. When they do have money, they feel very confident and very energetic and really good, and everything's right. So a lot of this movement in stock prices can create a lot of feelings, and some of the feelings are valid, but then some of them you might want to check. You might want to have some as a test of your emotional intelligence. It's kind of gain some self-awareness on how your mind and your psyche react when you seem to make money or don't make money, right? And what am I talking about? Well, when you look at the stock market can be this weird place that's like an emotional roller coaster because, one day you wake up and you realize your portfolio went from $8,000 to $10,000 and you're like, woo, I made $2,000 today, right? And then another day, it goes from 8,000 to 7,000 and you're like, dang, I lost $1,000 today. Right. And it affects your mood. I don't know about you guys, but it affected my mood for a long time. And I have a PhD in this stuff. So I've been feeling this way for a while. Right. We all feel this way. It doesn't matter how much of an expert you are. We all feel that. We all feel that high and low from your money going up and down. So in order to process that, emotional regulation is extremely important for success. That's something I've thought about my whole life, knowing how to monitor and manage my emotions so that I have the right emotion for the right situation, and I learned that a lot actually when I was actually trained to be a really good poker player. I don't know if you guys know this, but I'm a good poker player. I love it. It's a fun sport. I've won big tournaments and all that, but I'm not a gambler. I'm not into gambling. I don't want to give my money away, but I love the game. And you have to manage your emotions. You can't freak out. You can't get scared. You can't get shaky. You got to stay focused, right? So same thing is true. I think with investing, because remember that when the price of your assets goes down, you didn't actually lose anything. If you owned 100 shares of stock before the price dropped, you still own 100 shares of stock after the price drops. It's like my house, right? Our house changes in value probably every single day. You know, the amount that we can get for this house on the market is evolving constantly, right? And the only reason it doesn't bother me or that I don't think about it is because there's nobody that comes and knocks on my door and says, well, you know, yesterday your house was worth, you know, $382,494. Now it's worth $384,295. Nobody does that, right? I don't have that in my psyche that I have to deal with. It's an unrealized loss or an unrealized gain. But the house is the same. The square footage is the same. Has the same number of bedrooms, bathrooms. I still have my basement, my man cave that I love so much, right? All that's the same, right? So the actual asset has not changed, but the value, the market value of the asset evolves, and it evolves pretty consistently. In the stock market, you have what is called a very efficient capital market, which means that you can get up to the minute information on what your asset is worth right at this particular time. That is an asset that's a good thing, but it's also a bad thing. It's a wonderful thing, but it's also terrifying because what it can do is if you overthink it too much and you're too connected to these price fluctuations, it can create like weird amounts of emotional volatility, right? So I was thinking about it and I said to my wife, I said, you know, in a way, you know, when you look at your stock portfolio, you think your stock portfolio is worth say 20 grand, and then you find, and then the market drops and it's worth 17 grand. There's a philosophical question, and I said the philosophical question to me is, um, did I have $20,000 that dropped down to 17,000, or maybe I never had $20,000 in the first place, right? And it was all an illusion, right? So there's and I'm getting a little philosophical on this, but I want to kind of give you a framework to kind of understand this. I know all the equations that go behind making a stock market price, right? I know what those equations look like. I designed those equations. That's what you do when you're a professor. You sit around and you do high level mathematics to figure out like what it means to set up the specific discounted cash flow model and different statistical concepts that will allow you to come up with a stock price. And let me just tell you this, those models are really, really sloppy. Like, and not sloppy in the sense that they're precisely sloppy, right? And what I mean by that is the mathematics are pretty solid, right? These are good mathematicians. My master's degree is in math. So the math is right, but the problem is that you're trying to precisely know things which are simply unknowable. You don't know what, you know, you can make a projection of what you think Disney's going to make over the next 20 or 30 years, but you don't really know. You don't really know. You have an estimate, you have a guess, but you don't know. It's like predicting which one of your kids is going to be successful and which one isn't. You can kind of see some stuff, but you've never actually been to the future. So you don't really know for sure. Right. So if you so it's like so I think about it like a relationship. So imagine if you are madly in love with your boyfriend or your girlfriend and or your wife or whatever, or your husband, and you're really on 10 because you got this great relationship with this person that really loves you. And then one day they say, you know, I don't love you anymore. I'm leaving. I'm also gonna go move in with Frank down the street. Right. Well, then your whole world is shattered, right? You're like, oh my God, what just happened? I'm so depressed. I lost the love of my life. She doesn't love me anymore. Oh my God, oh my God, oh my God. Right. But then when you go deeper, you have to ask yourself another question. Well, maybe she never loved me in the first place, right? Maybe she was always messing around with Frank, and maybe the whole relationship was a lie, right? Has anyone ever gone through that, right? Like that's real life stuff. I went through that one time. I went through it. I got dumped, and the girl started dating another guy a week later, and I was like, wait a minute, wait, what? You know, right? So stocks are kind of like that too. What happens is that you can fall in love with the amount of money that you have. But then we get attached to that. We start thinking, okay, I have $10,000 because my stock portfolio is worth 10 grand. But what happens is that the price moves. What moves the price? The thing that moves the price is the release of information. The company makes an announcement, or they announce that their new product line didn't do so well. They didn't make an earnings report, and the price drops. Sometimes it drops because something new happens that nobody expected, right? But sometimes it drops because something is revealed that was already there. Do you understand what I'm saying? There's a difference, right? There's a difference between something happening, like somebody, you know, like, so for example, again, if my wife walks in and says, Boyce, I'm leaving, I gotta go. It could be because, you know, she loved me on Tuesday and doesn't love me on Wednesday, right? Or whatever. Loved me a month ago, but doesn't love me now, right? Or it could be that she didn't love me 6 months ago and I just didn't have access to that information, right? So, but either way, you know, I'm going to be wondering, Did something change, or was I living a lie in the first place? Was it all an illusion in the first place? So a lot of your stock prices, this is my point. This is why I make these weird analogies, but I like to relate it to things we understand, because we all understand love. We've all had our heart broken and all that. Is that sometimes stocks break your heart. And a lot of it's because maybe what you thought you had, you really didn't have. So what I would encourage you to do is not get too attached to these market prices. The market prices are great indicators of where you are economically. Sure, they mean something. They're valuable information. But I can tell you, as a person who has been on the absolute cutting edge of financial theory, for a long time, that these models are not precise at all. And anybody that presents this information to you as if they know all the answers and they know things for sure, that person's probably lying, because you cannot precisely know things which are simply unknowable. There are some things that are just not knowable, but you have to put something in the model anyway and come up with a price anyway based on your best guess. And sometimes not only is the guess bad, but you may be guessing at something where there's nothing. God has not given you any indicators to let you know what the right guess might be. And we do that all the time. We do that all the time. So I think about what the Buddhists say. The Buddhists say that the best way, the way to be happy. This is great, actually. When I think about it, I hope I'm not being too philosophical. But the Buddhists, one of the things they believe, if I'm not mistaken, I'm not an expert on this, is they believe that the key to happiness is to want nothing. Right? Don't get emotionally attached to things. If you have something, appreciate it, be grateful, have gratitude, but don't just spend your time wanting things, because that's how either people can control and manipulate you, or you can be hurt and disappointed if you lose the thing that you want or the thing you've gotten attached to. So try not to get attached to the stock prices. If you buy, what you can control is this. Look, if I buy 100 shares of IBM, I own 100 shares of IBM. That ain't gonna change. That ain't gonna change. That's it, right? So one day IBM stock might be worth $100. The next minute it might be worth 98. The next minute it might be worth 102. But no matter what, I own 100 acres of IBM stock. That's what I think about when I look at my portfolio. I'm literally in the process of consistent asset accumulation with minimal emotional volatility, because at the end of the day, I want my money to make me happy and not make me miserable. But I'm telling you, if you get to the point where you make a lot of money, you have to be really careful, because if you make a lot of money and you become addicted to the idea that you have a lot of money and then you lose that money, you'll be really sad and depressed. You'll wish you never had money in the first place. So just keep that in mind as you're sort of processing what's happening in your stocks and in your portfolio. All right, guys. So by the way, I want to remind everybody, if you have a question for me, that I'm going to read some of your questions and answer those. If you have a question for me that you want me to answer, you want me to look something up or whatever the case may be, just log in at theblackstockmarketprogram.com, theblackstockmarketprogram.com, and just go down, and there's a link right at the top where you can leave me a question. I will answer your question. I will look it up if you want me to look it up, and we'll talk about it in class. And those are the questions I always answer first. All right. So let me